All right. So, welcome to my first live stream on YouTube. I'm glad that you could be here if you're in the room. And today we're going to talk about CPI and inflation and what that has to do with real estate. But first off, I'm going to get started by letting you guys know that this is the first live stream. So definitely a test, and I'm sure there's going to be tons of technical glitches. So if you're out there and you notice something, please just let me know. And I am going to be monitoring the comments as best I can. I don't know if they're going to come through. I'm using a StreamYard, which is like a third-party application for streaming. Some of you are probably familiar with it, but if the chat doesn't come through, then just let me know, and I will do my best to monitor that. I'm also going to be watching it on YouTube as well, so hopefully the chats will come through on that. My name is Joe Poreka, and I'm a real estate agent, and I'm sure a lot of you have heard that CPI numbers and the Fed and interest rates and all this stuff it's like a super popular topic right now, and it's all intertwined. And the important thing to realize is that this information changes really, really quickly. So when we talk about this information, you kind of have to take it with a grain of salt. It is important stuff, and CPI, the Fed, interest rates, all of that certainly affects housing and affordability, but it can change literally at a moment's notice. Another thing to consider is that right now markets are hypersensitive to news regarding the Fed and interest rates. So even if a member of the Federal Reserve whispers about either rate cuts or rate increases, the market reacts really, really quickly. So again, like I said, it's really important to pay attention to this information, but also be aware that it does change really, really quickly. The stuff we're going to talk about today is CPI. And again, I'm a real estate agent. I'm not a financial expert. I am not a econ major or anything like that. I focus more on the world of real estate, buying and selling properties, mainly helping clients buy properties and advising them while they are doing such a thing. So I'm going to do my best to really interpret how this information is going to affect the real estate market and not so much financial markets or things like that. Now, if you are in the chat and you are an expert in this stuff, whether it's finance related or have knowledge with the stock market, bonds, things like that, please go ahead or write a comment into the chat, and I will do my best to answer it for you, or we can at least expand on that. So a little bit about myself. Like I said, I'm a real estate agent. I've been doing residential real estate sales for about 10 years now. I work in a city called Claremont, California, and all along the Southern California area. And I've had a lot of people sort of recently question, a lot of clients ask me, what's the market going to do? And we've had such a hard time with real estate ever since the pandemic. We have had a lot of firsts and a lot of new things. And the market was one way for a very long time, and it's been different ever since then. So I constantly have clients asking me, Joe, what's the market doing? What do things look like? Where do you think it's going to go? And I wish I could tell them with confidence. It seems like, it changes all of the time. So I wanted to kind of address this today because this is something that I get a lot from clients and that's been in the news a lot regarding interest rates. So as we know, right now, the Fed is keeping an extremely close eye on inflation. And the way that they're monitoring inflation is through an index called the CPI, which is the Consumer Price Index. And CPI essentially is the measure of how much things cost. And there's a couple of different metrics that they use, but one of them is called core CPI. And core CPI is the measure of cost for goods that are non-volatile, usually excluding energy and food, because those change quite a bit. So I'm going to actually pull up an article, and we're going to try to bring this up on the screen really quick. All right, and let's do Perfect. So we should see an article up on the screen there. And let's make it a little bit bigger for you guys. That'll make it a little bit easier for you to read. Again, this is my first time doing this, so please excuse any errors. So this is from Forbes.com, and this is titled "January Inflation Numbers Cause Stock Market to Dip." Um, Investors are receiving disappointing news once again as one popular inflation measure has come in higher than expected. And again, that's the CPI. Labor Department reported on Tuesday morning that the Consumer Price Index, or CPI, which we just talked about, rose 3.1% year over year in January, down from a 3.4% gain in December, but above the 2.9% increase economists were expecting. On a monthly basis, the CPI gained 0.3% compared to economists' estimates of a 0.2% gain. So these numbers might seem small, but it's the direction of the numbers that's kind of more of the problem. Economists figured that we would have lower CPI numbers, but instead they're higher, which means it's going in the wrong direction. And really, that's the biggest problem right now, is that things are going in the wrong direction. So um, that's what is causing some concern. And remember, like I said, the markets react extremely quickly to any news relating to this. Year over year, CPI inflation hit a 40-year high of 9.1% in June 2022, but elevated interest rates and falling energy prices helped stabilize prices throughout most of 2023. And again, so we did see those stabilize, and CPI was very high, but towards the end of 2023, those numbers were actually trending downward. And that was good for consumers because that meant that interest rates were lower. And I'll explain the relationship to CPI and interest rates in just a moment. Here's some closely watched numbers. So food prices were up 0.4% month over month and 2.6% compared to a year ago. So it's a little bit higher than what we were anticipating. Shelter costs, which this is a big one, continue to rise, gaining 0.6% compared to December and 6% compared to January 2023. So this time last year, shelter costs have increased by 6%. That's not a huge surprise. And this is one of the driving factors as to why CPI is as inflated as it is. Shelter costs, real estate, mortgages, rent, and the prices of housing are just at an all-time high, and we're not seeing much relief. And it's kind of it's a complicated relationship, and it's almost like a negative feedback loop. We have low supply of real estate, so real estate prices stay high, which means the cost of real estate stays high, which means the inflation of real estate stays high, which means interest rates stay high and everything stays high. So it's kind of a vicious circle. Energy prices were down 0.9% on a monthly basis and are down 4.6% over the past 12 months. So a little bit of relief in that sense. January marked the 11th consecutive month energy prices have declined on an annual basis. Gasoline prices were down 3.3% month over month and down 6.4% compared to a year ago. So that's all kind of trending in the right direction when it comes to energy, but shelter and food, not so much. Why the CPI matters. So inflation has been the Federal Reserve's top priority since early of 2022. That's when we had this big talk about, is it transitory inflation? Are we going to be headed towards a recession in 2023 or 2024? Will we get this soft landing that the Fed kept talking about, which may or may not be seen still? And the Federal Open Market Committee has raised interest rates 11 times since March 2022 in an attempt to bring inflation back down to its 2% long-term target. So again, the Fed has this target of 2% for long-term inflation, which means that generally the CPI number should be at 2%. Inflation should be at a 2% rise annually. That's the figure they like to see. It's kind of a natural, normal, healthy inflation. At times in 2023, when inflation was very high, we saw that number reach over 9%. And as we just heard and we just read, interest rates increase when inflation increases. And we're going to get a little bit more into that, into the why in just a little bit. Um, the FOMC's, which is the Federal Open Market Committee's current federal funds rate target range is between 5.25% and 5.5%. That is not the mortgage interest rate. That's the target range for the federal funds rate. Now, the federal funds rate and mortgage interest rates are kind of tied together. They do move in lockstep. So as the federal funds rate decreases, almost always, I won't say always because there's always exceptions, but almost always the mortgage interest rate decreases as well, and vice versa. And this is the highest level in 22 years. The Fed is also allowing up to $60 billion in Treasury securities and $35 billion in agency mortgage-backed securities to mature and roll off its more than $7.6 trillion balance sheet per month. Although the Fed has paused its rate hiking campaign since July of 2023, and in fact, we even saw some rate cuts in December in the mortgage interest rate market, Tuesday's CPI reading may delay a potential Fed pivot to interest rate cuts in 2024. Now, we did see mortgage interest rates decline in December, and that's because we were trending in the correct way with inflation. And a lot of times, what we see happen is the mortgage interest rate market will sort of pre-react to what the Fed will do or what the federal fund rate will do. And we call that baking in the change. So oftentimes, the mortgage world will see news or economic information or data from the Fed and say, hey, the Fed said that this is happening or is going to happen. We're going to preemptively make these changes and bake in a lower interest rate. And that's why interest rates actually went down in December a little bit. Of course, that all kind of, those gains were lost in early January when the CPI numbers went up and numbers weren't quite as good as some people anticipated. So there was a chief investment officer at Reagan Capital, which is a major firm, says the hot January inflation report may push the first FOMC rate cut back to the second half of 2022. So they're talking about, when they say a rate cut, they're talking about the Fed reducing the federal funds rate, which again is not the mortgage interest rate, but they're connected. So getting to the Fed's magical 2% inflation target may prove more difficult than expected and result in elevated interest rates for a longer period of time. Initially, we sort of thought that the federal fund rate would stabilize or decrease as early as March. And that's why back in December, mortgage interest rates started to really show and kind of go down. And there was an increase in the ability for buyers to buy at that time because the mortgage interest rate became a little bit more tolerable and it went down. However, that changed. We thought that we were going to see more interest rate decreases as early as March. And that's why that number in December for mortgage interest rates lowered. However, that changed. And that has certainly made a difference. Now we're seeing that interest rate cuts might not appear until the Fed's June meeting, which is a little bit later than March. And I'm going to share another item on the screen here in just a moment. And this is a really cool tool. Again, this is just an estimator. This is nothing that is written in stone, but this comes from a group. And there we go. You can see. So this is from the CME group, which is basically a think tank. It's a group that is looks at a lot of data, and they basically try to target when the Fed is going to lower the federal funds rate, and i.e. the mortgage interest rate would follow. Remember, those two move in lockstep together. So what they do is they anticipate what the target rate will be. And you can see in this graph here on the screen that right now, we have selected as the March 20th, 2024 meeting. There is a 91.5% chance that the federal fund rate will remain at its current rate, which is this area between 5.25 and 5.5. As we saw in the article, there's a couple of people that think that these rate cuts are not going to appear in March, which the CME group agrees with, but we could see them in June or July. So let's click on June. So the Fed's going to meet again on June 12th, 2024. It's their regularly scheduled meeting. And now if we look, there's some kind of positive outlook here. Right now, again, the current is this bar right here, 5.25 to 5.5. And there's a 23.4% likelihood, again, according to this estimator from the CME group, that the federal fund rate will stay there. And if the federal fund rate stays there, interest rates will stay there as well. However, what's a little bit more encouraging is there's a 54.3% chance that we could see a decline in the federal funds rate by 1/4 to 0.5% down to this 5% to 5.25% number. Furthermore, there's a 20% chance that we could see the federal funds rate dip as low as 4.75%. Again, this is simply a estimator. This is just a tool. And the CME group is not saying that this will happen, but these are, again, target rate probabilities for the June 12th meeting. So this should give buyers a little bit of hope out there. So essentially what we're saying is CPI has increased and it is not trending in the correct direction. However, it has only had very minor increases. They haven't been major. Now we'll see what happens moving into February and March. Again, as I kind of started the stream saying that anything can happen and it can change really, really quickly. So this information can really change at a moment's notice, and you have to pay attention to it, but also nothing is in stone and it can change very, very quickly. However, at least there's some good news on the horizon. If inflation doesn't dramatically increase, then these target rate cuts will probably occur. And the reason that CPI is related to inflation is pretty simple. So when the inflation figure goes up, it signals to the Fed that the economy is really hot and people are spending money. And there's a lot of money out there chasing too few goods. So essentially, people are spending too much. And when I say people, I don't just mean the end consumer, although that is typically the case. It just means entities in general. So that could be the end consumer, people like myself and you, or that could mean corporations, companies, investment firms, things like that. Money is just too loose, it's too free flowing, and too much money is being spent. So how do you curb inflation? How do you lower that? Well, the biggest tool that the Fed has in their arsenal is interest rates, and to raise interest rates. So when the Fed sees inflation going the wrong way, they increase interest rates. And the reason that that's the biggest tool that they have in their toolbox to fight inflation is because when you make money more expensive, people typically don't spend it. And what I mean by making money more expensive is increasing the interest rate. So for example, if someone were to take a loan out and that interest rate were 2%, like during the pandemic, well, that money is very cheap. The interest that they pay on that, which is the fee that they're charged to borrow that money from a bank or whatever it may be, is really low. So that the cost of that loan is very cheap. The money is cheap. And that's why you've probably heard that saying before. You've probably heard people talk about cheap money and expensive money. Well, there you have it. That's it. So when that interest rate is low, like 2% on a loan, it makes that loan very attainable, very easy. And that incentivizes people to spend money because they know that it's cheaper to do so. Now, if that interest rate shoots up and goes to 6, 7, or 8%, well, that money just became 3 or 4 times more expensive to borrow. And the fee interest is 3 or 4 times higher. And that is going to make a difference. Now, it might not make a difference on a small loan. For example, people might go out and still obtain a new car loan for $20,000 or something like that. However, it will make a really big difference on a big loan. So we're talking about a mortgage, or when a real estate developer buys a big parcel of land, or when an investment firm wants to make a large investment into a company or a startup. Well, if that money costs them 2 or 3 or 4 times more, they're going to be much less likely to spend that money. And when people spend less money, inflation goes down and we get it under control back to where the Fed likes to see it. So that's how the Fed can fight inflation with mortgage interest rates. And I'm going to bring up another article on the stream right now that's going to explain a little bit as to what that relationship between CPI and interest rates is. So this is from Investopedia, and this was an article that was written at the end of last year when sort of the CPI and interest rate talk sort of kind of got going, and talks about what is the relationship between inflation and interest rates. So the key takeaways from this article: interest rates tend to move in the same direction as inflation, but with lags, because interest rates are the primary tool used by the central banks to manage inflation, which we just kind of talked about. In the US, the Federal Reserve targets an average inflation rate of 2%. Remember, that's that golden kind of area that the Fed wants to see, that signifies a healthy economy, an economy that's growing and spending, but not spending at a pace that's dangerous, that would signal high inflation. An average inflation rate of 2% over time by setting a range of its benchmark federal funds rate, the interbank rate on overnight deposits. And that's that federal funds rate, which we talked about earlier. Higher interest rates are generally a policy response to rising inflation. Conversely, when inflation is falling and economic growth is slowing, central banks may lower interest rates to stimulate the economy, which again goes about what we just talked about. If the economy is doing poorly and is slow, they lower interest rates to make that money easier to get and more enticing to spend. And the way that how the Federal Reserve measures inflation is through the personal consumption expenditures price index, and the CPI. And those are just two different ways. It's just like looking at two different metrics. It's almost like, if you're a sports fan, a baseball fan, you're talking about, oh, how do we evaluate how good a player is? Maybe you look at their batting average and their on-base percentage, and you take those two things into account. It's just two different metrics to kind of measure the health of the economy. How changes in interest rates affect inflation. We kind of talked about this. When the Federal Reserve responds to elevated inflation risk by raising its benchmark federal funds rate, it effectively increases the level of risk-free reserves in the financial system, limiting the money supply available for purchases or riskier assets. Conversely, when a central bank reduces its target interest rate, it effectively increases the money supply available to purchase risk assets. So we can kind of see here inflation, the Fed funds rate. You have core CPI in this darker blue line, and you have the Fed funds rate in the lighter blue line. And you can kind of see how they've changed. The core CPI back in 2006 went way up. We had the Fed funds rate went way up because core CPI went way up, and then they tried to trend down together. So here we have a little bit of a disconnect. The Fed funds rate, still pretty low in December of 2021, but core CPI increasing. And that's where kind of the start of the problem was. So as you can see now, sort of where things are at is CPI trending in sort of the incorrect direction, showing increases, and inflation that's becoming kind of out of control. So what does this mean for real estate? Well, we've kind of already talked about the effect that this will have on mortgage interest rates. As we know right now, affordability is at an all-time low. And even just recently, Redfin put out an article, even with inflation being high, and even with affordability being terrible, we still have very low inventory, and demand is still relatively high, which is keeping prices high. typically when we have issues with affordability, prices tend to come down. However, that's not the case here. So the real estate market is definitely affected by inflation because inflation affects interest rates. Now, what I'm seeing is still that effect, like Redfin mentioned, the effect of supply and demand is still heavily felt. While we do have less buyers in the game right now, there's still just not a lot of houses for sale. And I always like to kind of um, tell people when we're talking about prices in real estate and activity in real estate, it's really important to remember that this is hyper local. So I'm in Southern California. I'm actually in the east portion of LA County, right on the border of LA County and San Bernardino or the Inland Empire. I'm also close to Orange County and Riverside County. I'm kind of at the convergence of four counties, four major counties as well. And this is what I'm seeing. This is what I'm noticing. Doesn't mean that this is what's happening in your area. Of course, if you live in a more rural area, then things could be different and you could be seeing something completely different. In fact, if you are seeing something completely different, write in the comments. Let me know what you're seeing in your area. Let me know where you are, either in the world or the United States, and let me know what inventory is like in your area and what prices are doing. Are houses sitting on the market? Are prices going up? Are prices going down? Let me know. In my area, it's still kind of early in the season. It's February 20th, so it's not really the prime buying and selling season, if you will. However, there's already a decent amount of activity. I can tell you just based on what I've noticed. I have clients that have come to me and are looking at houses to purchase. I'm working with an active buyer right now who's in escrow. I just closed on a property for an active buyer, and I've got a couple more looking right now. Also, conversely, I have people that are talking to me about getting their homes ready to sell in the spring and early summer, and they're very serious about selling their home. They're not just kind of inquiring about should I, it's more of what do I need to do to get this ready. So we're seeing, at least here in this area of LA County, San Bernardino County, the activity seems to be pretty good for this time of the year. Which, again, in this area, there's always going to be people that have a need to buy or sell real estate. Life happens and things will always change. And things will continue to come up that will cause people to either need to buy property or sell property. So what we're seeing here is while the demand is a little bit lower on the buying side, there still is a lower inventory. And that's why we haven't seen prices decrease. And if anything, they've actually increased a little bit. I will say that the market is getting a little bit more buyer friendly right now. We are seeing a little bit less competition. We're seeing situations where there isn't so many of these situations where we had back in 2020, 2021, and early 22, where it's like, whoa, there's 17 offers, there's 24 offers, there's 48 offers. I remember I had a client one time submit a offer on a property that had over 55 offers, which is absolutely insane. We're definitely not seeing that. We are seeing that in the affordable price point, and in this area, an affordable home is really anything under about 650,000 or so. Those properties, if they're priced well and presented well, are still getting multiple offers and a lot of interest. I just had some colleagues of mine host an open house here in Claremont, and they had a 2-hour open house on a Sunday afternoon. And they said that it was one of the busiest open houses that they have ever had. They had 75 people come through an open house in just 2 hours. The property is in a great neighborhood. It's a 4-bedroom property, and it's been very well maintained, nicely updated. It was presented for sale well, really beautiful photos. It was marketed properly. And wouldn't you know, they got a huge turnout at the open house. There's really no doubt that that property is going to sell. It's probably going to sell with multiple offers. And whenever there's multiple offers, there's an extremely high likelihood that it's going to sell for over the asking price. That property, just for reference, is listed at 1,025,000. So just a touch over $1 million. So we're still seeing in some cases that there is the multiple offer scenario. However, I just submitted an offer for clients that got accepted, and we were the only offer. There was a lot of interest in the property, and there were a lot of showings. There were a lot of people at the open house, but we were the only people to provide a written offer to the seller. And that obviously makes it a little bit easier on the buyer, with less or a little competition. So it's certainly a better climate for buyers right now. I do believe definitely that if the CME group is right, and we do see a rate decrease in June, if the next CPI report is lower than the one that we had in January, then that is an indicator that we still will see a rate cut. The Fed's pretty optimistic about a rate cut. Of course, depending on who you talk to, there's people out there that will, well, they'll argue any point. And you have people kind of in the corner that say, well, the Fed's crazy. They're off their rocker. And, there has to be a substantial change. And there's a lot of weirdness in the market right now, which may or may not be true. I don't know. That's not my expertise. And I'm not a finance or economics guy. If you are, let me know in the chat what you think about the state of the current economic market. But if the rates do go down, if inflation trends the correct way, I definitely believe that we're going to see interest rates decrease, which will mean there's more buyers in the market, which will mean there's more competition. Hopefully, interest rates will come down enough to get some of our sellers to sell. As we all know, a lot of sellers are kind of locked in. They have what they call these golden handcuffs of the interest rate, being 2.8% or 3%. In fact, I think the statistic is something about 60 to 65% of all homeowners out there have an interest rate under 4%, and another 20% have an interest rate under 5%. So what is that? Like 80% of all homeowners have interest rates under 5%. That's really good. And of course, that's going to make it so they don't want to move, because they're going to have to give up that interest rate of 3, 4, 5% and inherit an interest rate of 6.5 to 7%, which is where we're at today. If those interest rates can come down to even 6% or less, if we see, I think, 5 point anything, that's going to incentivize people to move. There's a lot of people that want to move. There's a lot of people that have a lot of equity in their home. And there's a lot of people that want to move to a different part of the country, want to move to a larger house. There's a lot of people that want to move to a smaller house, i.e. baby boomers, but they don't want to give up their interest rate. So I do believe that if we see lower interest rates, we will see buyers re-engage into the market. But more importantly, we will also see sellers re-engaged into the market. And if we can get both a little bit more buyers and a little bit more sellers, we're going to come across what is a little bit more of a normal, typical real estate market. And I think that the odds of that, again, this is just from what I see locally in my marketplace and what I see based on what I know. I think that the odds of that happening are not a long shot. Again, this information changes so quickly, and we'll have to see what a lot of the financial reports come in as. But if we do see low interest rates, it's going to be beneficial for both buyers and sellers. The Fed's going to be very careful about that, though, because, and I did I had a great comparison on my YouTube channel for a video that I did where I talk about we are not in a 2008 style market. We're just not. This market is completely different than 2008. And I'll explain a little bit more why in a moment. But we're in a market that much more resembles the 80s. In the 80s, which is slightly before my time, but my parents' time, in fact, my parents were in their prime home buying ages in the 80s, we went through incredible interest rate increases. We had interest rates as high as 17%. And it wasn't rare for people to get interest rates on their mortgage of 10, 12, 14%. And in fact, there's stories of people that I know and my parents and their friends saying, I felt lucky to have a 12% mortgage interest rate. And of course, for us, that's like insane to think about because that is double where we're at right now. Um, but what happened in the 80s is we had a lot of inflation, government spending went way up, and there was concern about interest rates. Kind of sounds very similar to what we have today. And the Fed had some positive signs of a decrease in inflation, and they lowered interest rates relatively quickly. Well, that caused the infamous double dip recession. So we had a recession. We started to come out of it. Because we came out of the recession, the economy was slow. The Fed's decreased interest rates, and then people started spending again way too quickly. And that sent us into another recession, hence the double dip name for that. That's exactly what our Fed wants to avoid, which is why they're trying to engineer this soft landing approach where we kind of gradually float down in terms of our inflation and we get to a much better interest rate kind of slowly but more naturally and just a little bit more comfortably for consumers. Now, the issue with where we're at today and 2008 is pretty simple. In 2008, we had really, really, really bad loans, and we had a financial problem that started to affect the real estate sector. So the main problem with 2008 was, if you've seen The Big Short, this is kind of going to be a quick synopsis of that, which, by the way, is a phenomenal movie if you want to learn about the real estate crisis of 2008. But what happened is there was loans that were made that were horrible loans, which means that it was money that was loaned to people that should not have been loaned money. Those loans were packaged with good loans into a big portfolio of loans. And there was some Wall Street rules that said if these loans are packaged in a certain way, then the grade of that package didn't go down. So essentially, investors were buying these loans that they thought were good, but on the surface they looked good, but deep down they were terrible, horrible loans. But they paid a premium price because they thought they were good loans. And once they found out and the jig was up, it all came crashing down. So in 2008, we had bad loans, and people were able to get loans for over 100% of the property value. So that would be like if you wanted to buy a home that was $500,000 and you went into a lender and said, I want to buy a home that's 500,000. Can you give me a loan? That lender would turn around and say, yes, I'll give you a loan for that house, but I won't give you $500,000. I'll give you $520,000 because the value of the house is going to go up so quickly. That was a very big mistake. Additionally, people could go to a lender and literally give fake information or non-existent information, or they could go to a lender, say, I need a loan, and they didn't even verify employment or income on that person requesting the loan. So we had people that had 3 and 4 and 5 mortgages that couldn't even afford one, but they were able to go out and buy a home or buy multiple homes, and that created a really, really big problem. Once the market discovered that there were terrible loans happening, it all came crashing down. Now, that was 2008's problem, was bad loans that were called due, people couldn't pay them, and we had a flood of foreclosures. What that did is that crashed real estate prices because we had a huge increase in inventory almost overnight. And when I say overnight, I mean over the course of maybe a month or two. But in the financial world, in the real estate world, where we're talking about 20 and 30 and 40 years, 2 months is basically overnight. And we had a huge crash. That is not where we're at today. Today, our biggest problem is that we have extremely low supply and we still have a relatively high demand. After 2008, a lot of builders went bankrupt and they lost a lot of money. And a lot of those builders didn't come back into business. I mean, think about it. If you were in an industry and if you opened a business and your business collapsed would you turn around and open that same business again? Maybe not. You would probably rethink about what you want to do and maybe reinvest elsewhere. Well, that's exactly what happened to home builders. And home builders decided that, hey, I don't want to throw my hat back in that ring. It's just too risky. So from 2008 until about 2018, there were few home builders that were active and they were building way too few of homes. So, uh, as we recovered from the Great Recession and demand for homes was low because people got financially wiped out, the lack of inventory wasn't a problem, but it was a lagging effect. So we didn't really realize the problem of our lack of building as a nation until very recently, i.e., 2020. So we were very low on building new homes from about 2008 to about 2018. 2019 or 2020 was the first year where we were at average for new home builds completed in the United States. All the previous years we were below average. Um, and so that created a deficit in supply. The other thing to consider is during that time, we didn't stop growing as a population in the United States. In fact, millennials were coming of age in that time. And millennials are the biggest group of people, the biggest generation that we've ever seen. And millennials are now in their home buying prime. And I don't care what anybody says, millennials definitely want to buy homes. They might have a very difficult time actually doing it, but that doesn't mean they don't want to do it. So it's one of those things where we have not built enough homes. We have people that want to buy homes, i.e., the demand, and we have high interest rates right now, which are making affordability difficult, and they're not encouraging people to sell homes. And you arrive at the crisis that we have today. So that is why when people talk about a 2008 style crash, I don't see that happening. And I've got more details in the video that's on my page and titled it's we're not in a 2008 style crash. So if you haven't watched that video, you should definitely go watch it. I do a really in-depth dive with a lot of charts and analysis on why I don't think there's going to be a 2008 style crash. Um, and the supply and demand issue is a pretty big and basic reason on why I don't think we're going to see a huge devaluation in home prices in terms of assets. And people have different opinions on this, which obviously is completely fine. But a lot of people, will talk online. There's all sorts of, crash bros on YouTube and in the media that like to blame real estate prices on a myriad of different things. I just saw an article recently that said baby boomers, I think it was from Fox, baby boomers are the ones to blame for the housing shortage because they're not moving out of their big homes. Well, they're not moving out of their big homes because interest rates are high. And like I said, why would they give up their 2 or 3% interest rate and buy a home where they have to pay 6 or 7%? The real problem is that we have institutional investors buying affordable homes left and right. That's the real problem. It's not boomers. It's not millennials. It's not mom and pop landlords that own 1 or 2 or 3 properties. It is Wall Street, but that's just my opinion on that. Um, I don't think home prices are going to decrease by 30 or 40%, at least not as a blanket statement overall. I do think that there are areas that are ripe for a little bit of a correction in pricing. I think if your area has a lot of new homes being built and saw a big boom of people moving during the pandemic for remote work, I think some of these areas in Texas, Tennessee, um, uh, Washington State, some of these areas where kind of people left Seattle, LA, New York, things like that to find more affordable real estate. Those areas are probably a little bit more prime to price corrections. But your major markets, I don't see it happening. We simply have a lot of people and we don't have a lot of homes. So a lot of the crash bros that say, oh, it's imminent that there's a housing crash, I just don't see it. In my market, homes are not sitting on the market. It's rare to have a home stay on the market for more than about 2 or 3 weeks. If it is on the market for more than 2 or 3 weeks, it means that the seller or the listing agent is definitely doing something wrong, or the property is overpriced. Um, there I just don't see a huge, 30 or 40% price decrease in the cards in general for most real estate. I just don't see it happening. Now, I would love to hear your thoughts. If you do think that that is something that's going to happen, then please let me know in the comments what your expectations of real estate are. I, of course, would be happy to see what you think and give you my 2 cents. Um, but I don't see that happening, especially in these areas. The only way that there would be a really significant price correction or decrease in pricing in the magnitude of 30 or 40%, which again, I just don't see that happening. There would have to be major geopolitical issues that come up. There would have to be a pretty fundamental and significant issue with the financial system, which I'm not going to say is impossible, but I don't think it's likely. The the lending process for real estate was completely overhauled in 2008 or after 2008. There's all sorts of new requirements. Anybody who's gotten a mortgage in the last 10 years will tell you that the amount of paperwork you have to do to get a loan is insane. The lender has to verify your employment like 3 or 4 times throughout the underwriting process. They check your credit multiple times. If you go out and charge a credit card too much, they'll pull your loan. So the odds of having a financial collapse like 2008 because of bad loans, it's not likely to happen. So ultimately, I think 2024 is going to be an interesting year. The end of 2022 and all of 2023 was a little bit quiet in terms of real estate transactions. Transactions were down overall, and there was just less homes transferring, buying, and selling. I think 2024 is going to be different. I really do. That's just not my opinion as a real estate agent. That's just my opinion as someone who, um, you know, uh, looks at the numbers and has a good pulse on what actual buyers and sellers want to do. Again, it's really important that you remember that this is uh, really, really specific to your area. And that's one of the problems with a lot of the doomsdayers and the crash bros is they just make a lot of big blanket statements, and they talk about how real estate prices have to crash everywhere because they're too expensive. Well, that's not a real reason. One of the things you'll hear a lot about, from some of the crash bros on the different media outlets and social media is that this idea that new builders are hiding inventory. Um, Listen, I can only tell you about the new builds that I'm familiar with here. I can't tell you about the new builders in Texas or Georgia or Tennessee. I'm not familiar with those areas. But what I can tell you is that a lot of the times, new home builders don't put their inventory on the MLS, and you don't see it on Zillow. You don't see it on Redfin. So when these crash bros go around and say, oh, look, there's 10 homes for sale that are vacant right here, and you don't see those on the MLS and you don't see them on Redfin or Zillow, that's shadow inventory, or they're suppressing inventory. No, they're not. What new home builders do is they sell direct to consumer. They oftentimes don't put their new listings in the MLS. What they'll do is they will put maybe 2 or 3 or 4 homes into the MLS. And what happens is they have a development where there are 30, 40, 50, 100 homes that they're going to build. And rather than list 100 listings into the MLS, because that's a lot of time, energy, and work, what they're going to do is they're going to list 3 or 4. And that is enough advertising in and of itself, because that goes to all the third party aggregate websites like your Redfin, Zillow, Trulia, Realtor.com, Homes.com, all that stuff. And when home buyers go on, they know that, hey, this is a new home from Lennar that is I'm seeing on Zillow, and they're saying that there's going to be more models available, and this is just one model. I'm going to go down to this site and I'm going to take a look at this model home. So you go down there and then you end up purchasing one that is not quite completed or is not even yet started. And that is an example of inventory that's available, but is not being advertised. It's not in the MLS, it's not on Zillow because, again, they've only put 3 or 4 of their properties online. Uh, they just target consumers directly. We've all seen the signs off the streets and the freeway that say, Lennar, new homes this way, new homes this way. Big billboards on the freeway that say, Oak Crest community starting at the 700,000s or whatever it is. That's how they target it. When you have resale homes, i.e., homes that are being sold, by a seller on the open real estate market with a real estate agent in the MLS, the MLS, Zillow, Redfin, all those, that's the best way to market your home. Uh, People aren't going to know it's for sale otherwise. I mean, sure, you can put a sign in the front yard, which is a good way to let people know, but you're not going to reach the masses that way. So this idea that there's, shadow inventory or hidden inventory is nothing new. And that's just another reason that there's not this sort of, you know, idea that, oh, there's all of this inventory lurking and there's people out there right now that are hiding homes from others, and it's decreasing what's available. That's just something that I personally don't agree with, that argument and that tactic. So ultimately, at the end of the day, um, we still have a low supply and a high demand, especially in coveted areas like LA County, Orange County, Ventura County, things like that. Again, it might be different in your area, but this is just what I'm seeing here. And again, all this goes back to affordability issues. If the core CPI goes down and we do get a interest rate decrease, well, that's going to be a huge fire starter, in my opinion. It's going to make the properties more affordable because, again, that money is going to get cheaper. Like we went back to earlier, when that rate goes down, it's easier to spend that money. It's easier for consumers to digest spending that money. It becomes more affordable to spend that money, which means their money goes further and they can afford to buy a house. So if that all does happen, I do wholeheartedly believe that we are going to see an increase in activity in this year and into 2025. And if we bring the CME group, let's go out far and let's bring up the CME group. I think I still have it open. I do. And we see this one. So if we look at the CME group, this FedWatch tool, let's go out like really far. Let's go to December of 2024. So it's the end of this year. Where do we think rates are going to be? Look at that. Now, again, this is solely a estimation. This is just a projection of a couple of really smart, well, more than a couple, but a group of really smart financial savvy individuals. And this is where they think rates are going to be. Again, this is the federal funds rate that we're looking at, not the mortgage interest rate. But as we've discussed, those two are locked together. So when the federal funds rate goes down, mortgage interest rates go down. And right now, currently, we are, get this out of the way, we're currently at 525 to 550. And there is only a 2.9% likelihood in the estimation of the CME group that by December of this year, we'll still be there. There's a 12% chance that we're looking at 475 to 500 basis points. There's a 27% chance that we're looking at 450 to 475. And there's a huge 32% chance that we're looking at 425 to 450. And we even have a almost 20% chance of hitting 400 to 425. So again, this is encouraging, although it is just an estimation of where we could be. But if we count this up, we're looking at uh, almost 60% there plus 80%. I mean, we're looking at over a 90% chance of being under 500 basis points for the federal funds rate. Again, if we see these types of rate uh, movements, it could mean that we have a very, very active 2024 and into 2025. Of course, there's a long time, almost 12 full months, well, 11 full months between what we're seeing here and where we're at right now. Again, a lot can change. And our buddy Jerome at the Federal Reserve uh, could whisper any number of things that could hugely dictate this. But as of right now, it looks encouraging that we are going to be headed in the correct direction. Now, I will say that I kept a close eye on this CME tool at the end of last year, anticipating March rate cuts. And of course, the CME, like everybody else, did anticipate that rates would be cut in March. Um, we can't go back in time and look at that because this changes almost daily. But that didn't happen. So again, this isn't gospel. This isn't written in stone. This isn't what's going to happen, but this is just their probabilities. So over here in the corner, you can kind of see in summation, there's a 0% chance that there's a hike. There's a 0.3% chance that there will be no change. There's a 99.7% chance that as of the December 18th, 2024 meeting, the Federal Reserve will lower the federal funds rate. Let's get crazy now and let's just go into 2025. Let's go to March 2025. This is way, way, way out, but let's just see what they say. And again, kind of more of the same. So a majority percentage probability is at 28.1%. I'm sorry, 28.1% to be at a federal funds target rate of 400 to 425 basis points. And again, up here, a 99.9% chance that we will have an easing in interest rates. Again, this is like way, way, way far out in advance. And this could definitely change. But it's interesting to see that the CME group, which again, is a really, really smart think tank, this is what they think is going to happen. I'm just going to put the June one back on the screen. So those of you that are kind of just joining us, following in, you can kind of see this. And you can go to the CME group. If you just Google CME group Fed watch tool, you can bring this up yourself. They do all sorts of stuff and regarding the Fed and interest rates. So you can kind of play with this yourself, look at yourself, see for yourself what the CME group thinks is in store for what could happen with the federal funds rate in the future. So again, this is a pretty big reason why I think that there is going to be a pretty active market. I do think that the real estate market is probably going to shake off the sort of the cold winter that it's been in the last year and a half or 2 years. Of course, that all remains to be seen. And I'm just one real estate agent in one area. So, take my words with a grain of salt. Of course, if you live in an area that's vastly different from mine or internationally, it could be completely different. I know that right now in Germany, they're having some issues with housing and possible recession. I know that in England, they were talking about how, as of a week ago, I read, we're in a recession. And today I read an article that says they're out of a recession already. So again, this information changes super, super quickly. And it's good to keep your eye on it. But honestly, at the end of the day, and this is the same thing that I tell clients when they ask Joe, should I buy or sell a house right now? Is it a good time? Ultimately, you have to just block out some of the noise. It's good to keep it in mind. It's good to be aware of this stuff. But ultimately, at the end of the day, you can't make your decision based off of one article or one person on YouTube or one person on Fox News or one person on MSNBC. That would be foolish. You need to really listen to yourself. And what you need to do if you're thinking about buying a home right now is you need to evaluate, hey, Is this something I'm ready for? Do I have a stable job? If I'm buying the house with another person, whether that's a partner, a spouse, a wife, family member, or friend, is that relationship stable? Am I going to be in this geographic region for a while? Last thing you want to do is buy a house and then have to move after 2 or 3 years. That's usually not a good position to be in. And do I need to move? Do I need to buy a house right now? Is it the right thing for me in terms of, do I need more space? Do I need more privacy? Of course, it is a great economic investment, and homeownership is one of the best tools to start accruing long-term wealth. But that doesn't mean it's a good decision for you to do right now. So ultimately, at the end of the day, you need to think, is this something that I can afford? And am I in a spot in my life that's going to afford stability for me to buy a house? Um, I always recommend that before you even talk to a real estate agent, talk to a mortgage lender. That's the best place to start when you're considering buying a home. You want to look for a mortgage lender that is a direct lender. Some of the mortgage brokers out there, well, they don't have the best intentions in mind. Now, don't take offense to that. Any mortgage brokers that are watching this, of course, there's always exceptions to every rule, but I would start with the direct lender and just simply go through the pre-approval process and have a conversation. The pre-approval process should be no cost. It shouldn't take more than a day or two. It does require you to submit a lot of paperwork to a lender, but most of that paperwork you have for taxes anyway. So it's really not that complicated. And the reason you want to talk to a mortgage lender first is because there's no obligation, there's usually no cost, and then you'll have a really, really good idea of how much money you need for your down payment based on the loan amount that you're looking to obtain. And also, most importantly, you'll have a pretty accurate estimate of what your monthly payment will be. And then once you know how much you need for your down payment, and once you know how much you need for your monthly payment and what your monthly obligation will be, then you can start to look at different properties and houses at different price points to see what works for you. Um, Additionally, it also helps to have a pre-approval because then if you do come across a house that fits your budget, fits your needs, and is the right one for you, you can actually make an offer and pursue that property. If you don't even have a pre-approval letter, well, there's nothing you can do. So a lot of times people start by kind of window shopping homes or they go to open houses, which, don't get me wrong, that's a fine thing to do. Sometimes that's not the best thing to do. And you're going to want to start by getting a pre-approval letter because that will qualify you, and you will just have a lot more information regarding your possible home purchase. And again, that's no cost. That's something that you can do regardless of what's going on in the market, regardless of what interest rates are. It's just about obtaining more knowledge. As we all know, knowledge is power. And if you're on the fence about buying a home, the only way that you can make a good decision is if you are well informed. So it's really, really important to be armed with good information. And that starts with getting a good mortgage lender. If you do need a lender resource, I'm not a lender, but I work with a lot of them. I don't get any kickbacks from lenders. In fact, it's illegal to do so. But if you're looking for trustworthy lenders, let me know. I have a whole network of lenders that are available, and I'm happy to just send you some information regarding lenders that you can talk to. So that's probably the best thing that I can advise right now. It may not be a good time for you to buy a home. Interest rates are high. Affordability is insane right now. There's not a lot to choose from, but doesn't mean that you shouldn't be prepared. So I think ultimately, at the end of the day, we're looking at a financial market that is really complicated. I think that we are faced with some interesting turn of events ahead in the immediate future. It'll be really interesting to see what inflation does in the next 1 to 3 months and how that is interpreted by the financial markets. It's very interesting that the stock market, both indexes seem to be doing really well. I'm constantly reading about how there's new highs being set at almost every week. So that's somewhat of a good indication that there's strength from that financial sector, um, it'll just be really, really interesting to see what happens with the markets moving forward. I think that there's a lot that could happen, but again, it's hyper local. In my market, I'm fully anticipating a pretty busy 2024 and 2025. I'm already starting to see that. At the end of the day, regardless of interest rates, there's always going to be need for people to buy and sell houses. And it doesn't matter what the reasons are; it's going to happen. So I think that, like I said, the interesting part with where we're headed will be inflation. Obviously, will be the Fed. Mr. Powell has been the topic of hot debate recently, and I think it's going to only continue to be closely watched by all of those involved. I hope that you enjoyed the stream today. Again, this is my first stream, so I hope that you guys enjoyed it, got some value out of it. If you have any real estate assistance, let me know. You can reach out to me, send me a message on Facebook, send me an email. I'm happy to help. I will be live streaming again probably this time next week, so feel free to join me. I'm not sure what the topic's going to be about yet. We're going to figure that out. But if you guys have any real estate questions, feel free to reach out. Let me know in the comments what you think about where the Fed is headed, what interest rates are going to do, and where this market is going. I would love to hear your thoughts. Also, let me know where you are. Let me know what you're seeing in your local marketplace, because I'm always interested to see what's happening in the United States and around the world. So thank you so much for watching. Once again, I'm Joe Boreka. I'll see y'all again real soon.